Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting, so the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hi guys, welcome to The Big Picture. My name is Joe Cruey. I'm at Paradigm in the weeds around everything crypto vol markets. Joined here by my colleague David Brickell, as well as Greg Magadini from Amberdata, who has been on the podcast a couple times now. Before we begin, if you could just smash that subscribe, hit that like button, really helps us promote our channel as we strive to become one of the go-to shows in crypto derivatives. So just jumping right in, last week, so we had Kyle Doan from Archon, and one of the things that we discussed was this convergence of ETH vols relative to BTC, and how this convergence drove some pretty sizable outright upside interest given the low level of implieds and the busy macro calendar that we had. I think one of the reasons for this ETH convergence is this presence of this large sort of overwriter in the market, and it's quite topical because this guy was actually active earlier this week, starting on Monday, and then half the size also printed on Tuesday. So over this past week, so 63,000 of the June-September 2200 call calendar was sold. Like in Ethereum, it's just massive. Right? So that's a total of huge. 150K like net Vega that was sold into the market through this structure. And there was also some activity as well that was happening on screen in just like the SEP outrights. So we think honestly, the Vega that was sold, net Vega that was sold, was probably closer to like 200K, right? And like in equity land, that would be like a decent clip. And like we're talking about the Ethereum vol world. And something that we mentioned on this podcast previously, it's, these quarterly rolls seem to be the largest trade. So back in December, these guys also did a roll, and it was from March to June, and that was around 120K Vega. So this is the biggest one that we've seen, potentially suggesting that this overwrite program is also scaling in size, and we expect this to potentially weigh on the curve. And talking to, like size like this, it's just tough for makers to absorb. It kind of speaks to this ability, and we've spoken to this previously on the podcast of large takers in this market to be able to just like dwarf the collective balance sheet of even like some of the biggest makers in crypto derivatives. Like this is like a phenomenon that doesn't really exist too much in any other asset class, kind of this except for crypto. And, given the term structure that I'm sure Greg will go into it in a little bit, it kind of seemed like this was like an opportunistic sort of trade. We're not even close to really June expiry yet, but they decided to roll this trade now. And taking a look at the ETH BTC implied vol spreads and kind of what these things have done, these are kind of back to flat/negative territory, and they've kind of only really just been tracking lower. But that being said, they're really tracking lower in line with the realized vol. So in that right chart is the ETH BTC realized vol spread, and that has basically just been going on a one-way downtrend since the start of the year. Like at one point, the 30-day ETH realized vol was trading up to 5 vols under BTC about a month ago, but that has since recovered. So, Greg, I'm just curious, kind of what are your views on what's going on in like the ETH vol complex and, potential, you just run with it, potential opportunities to potentially even take advantage with it.
Yeah, totally. So first thing I want to say, it's Greg Magadini, not Mandini. So just want to correct that. Never heard Mandini, but don't hate it. It's all good.
I always say Joe Croy.
I'm just glad he didn't say Greg Mankini.
Oh man, you should have seen how I grew up. They love to make fun of that name for sure. All right, but basically looking on the implied side, if we're looking at the DVOL index, the Deribit VIX for Bitcoin here on the left and Ethereum here on the right. And then right below, we have sort of the ratio between the two. So we can see that the ratio is near 1.0. So ETH and Bitcoin vol, implied vol is about the same. That's kind of interesting. And, this is a rare event, so to speak. And if we look at the realized side, so here's realized vol going back to May 2016. So we're looking at about 7 years of realized vol. And so if I look at the sort of the quartile distribution on Bitcoin here to the left, so we can see the interquartile 75th to 25th range is 57 vol to 90 vol for the 90-day window. Right now we're below the 25th percentile, but we're not quite at the minimum that we've seen. We've seen lower vol for Bitcoin. But if we're looking at ETH, we're kind of touching that edge of the lower bound for the past 7 years. So that's kind of interesting to me. That's showing us that, how much farther does realize have to go? I mean, realize can do anything, but it's just kind of one of those things, just keep mean reversion in mind. And then right below, we can see the spread between realized vol. So this is just 30-day measurement, realized vol between Bitcoin and ETH. We can see that typically ETH in orange, this trades above Bitcoin vol, has nice episodes of, easily 30 points, 40 points spread at extremes, like here in July 21, stuff like that. So that's kind of interesting to me. But what's really interesting is the term structure. So typically when we're in a low vol regime, you have a lot of contango in the term structure because vol is low right now, but theoretically going forward in the future, it should go back towards the median. And right now there's an opportunity here where the front end of the curve, even though overall vol levels are low, the front end of the curve could theoretically steepen. So like if we're thinking in the short term, market still needs to consolidate, whether we're talking about Bitcoin or ETH, things still need to kind of process out. We could see the front end steepen more. So there's something there. If you want to be long some vol, you can finance it by selling some short end stuff. So there's a little bit of that opportunity here. So we can see episodes like going into the end of the year last year. Let me just jump back to the realized real quick. So we can see going into the end of the year last year, January 2023, December, January, we're a little bit lower than where we are now on the realized side. But on the term structure, I mean, look how steep that was. We're like trading in a 70 handle, and right now we're more in sort of the 90 handle in terms of term structure richness or discount. So there's room for the term structure to steepen. So if you want to play the short vol side, there's something there. But then on the long vol side, basically the back end seems kind of relatively interesting. So I just want to jump. I don't know if you guys want to, before I move on, if there's anything you guys want to say about that. Otherwise, I'll sort of jump into the dealer positioning.
Just Greg, just for listeners who may or may not know, how do you define in terms of period wise, like the front end of the curve versus the back end? How do you think about that?
Yeah, and in terms of like steepness as well, right? Like what is the front end? What is the back end? Like what is the proxy that you're using to determine like the steepness?
Yep, that's a great question. Thanks for asking. So we look at 7-day at the money vol, 30-day, 60, 90, 180. And so what we're doing here is we're quantifying the net difference in ratio, not in spread, but in ratio of 7-day versus 30-day, 7-day versus 60, 7-day versus 90, 7-day versus 180. So there's kind of four measurements there. Then we do 30 versus 60, 30 versus 90, 30 versus 180, so on and so forth, all the way up the curve. And then we take the average. And so we can see the average, if there's a discount, or an average if it's a premium. And so that's kind of the way that we define it. So we kind of quantify the net difference across those measurements.
Got it. So you're basically just looking at the difference in the vols between the short end and the long end at different points on the curve, and then just taking an average of it. Are you taking a weighted average, or are you just taking a arithmetic mean?
Just a straight average, yep. And we're averaging the ratio. So if we're in a high vol regime, if we're looking at a spread, it'll be different. But if we're looking at the ratio, it sort of normalizes for different vol regimes.
Right.
So
cool.
Yeah. So one of the things that's interesting. So I mean, we just talked about that big trade, that sort of that roll. We had that buying back the June $2,200 call, and then selling September $2,200 call. And so you're seeing like a lot of that cover call selling in in ETH. And so what we're seeing here is net dealers are just long a lot of gamma. They're essentially long vol. This is the bottom chart here. And then if we look at Bitcoin, dealers are still kind of net short / net flat. So there's a lot of supply of people willing to sell vol in ETH. And I mean, obviously come to that same conclusion by looking at that covered call trade, but it's interesting to just see how dealers are positioned. I mean, this is essentially, kind of the highest point in nearly in the past 9 months that we've seen. So it's kind of like a interesting phenomenon that we're seeing sort of market makers have to deal with. So there's just kind of a lot of supply
driving these potential vol dynamics where most of the demand for vol has really existed in BTC this year, but there hasn't been too much demand for ETH vol, at least from our big taker clients. And that combined with the large overriding supply that we see here, and there's also a massive flow that is the second biggest flow in the ETH market that is occurring OTC. And obviously we can't say who that is, but it is a very similar, vol supply sort of program that is being rolled every month and delivering a ton of gamma and a lot of vol to the market. So you think it's those sort of supply and demand dynamics that are kind of leading to this overall conversion?
Yep, for sure. That's how I see it in my mind. And the way that I think about it, it's kind of like cyclical. So like, I still think that there's a time where enthusiasm comes back into ETH and we go back towards more typical relationships between Bitcoin vol and ETH vol. But right now, we're not in that cycle yet. So this is kind of where the opportunity brews, so to speak, in my mind.
Right, right. And in terms of like the opportunity, you put out a pretty good Twitter thread I think it was a week ago, kind of just talking about the cheapness of ETH vols. And I think you especially looked at the downside of the ETH vol. I think you have a nice chart where you were looking at the ratio of ETH DVOL as a ratio to at the monies. And because the DVOL's weighting is a similar methodology to the VIX, downside vols are going to be weighted more heavily in that DVOL calculation. So by comparing that DVOL versus the at the money, you get this sort of like downside convexity proxy in a way. Do you want to go into a little bit of that?
Yeah. So basically, VIX methodology essentially targets constant vega. So like an at the money option on $100 stock has basically 10 times more vega than an at the money option on a $10 stock. So if you're waiting for constant vega exposure, lower strikes have sort of more weight to them in this calculation. Higher out of the money strikes will have less weight. And so when you're looking at the DVOL index and then you take out the belly by dividing by at the money vol, kind of puts have like an oversized effect here. And if we look at this chart here, this is true for both Bitcoin and ETH, but basically we're looking at the lower 10th percentile since DVOL inception in, call it April 2021. And we can see that right now the wing component, and especially because of the put weighting, is kind of at the lower 10th percentile that we've seen it since inception. So that's a little bit guiding my hand there in terms of what's cheap right now, relatively speaking.
Right. Yeah, and I think that kind of speaks to the flows that we've seen on Paradigm in 2023, even versus 2022. Like in 2022, there was like a fair amount of ETH downside flows because the world was blowing up. VCs needed to buy 10 delta puts and things like this to be able to hedge their treasury and their VC investments. And to be honest, Greg, we haven't really seen like any of that. Like maybe it's all OTC now or what have you, but on Paradigm, you rarely see like, oh, somebody just came in and bought like a ton of like ETH downside convexity, and this counterparty doing this is clearly just like a natural hedger that is trying to hedge their treasury. You just don't see that stuff anymore. So perhaps that's also a potential driver of why it looks so cheap, because there's just nobody really doing the trade.
Yeah. Interesting point about the world blowing up kind of last year, and you're seeing a lot of demand kind of for ETH downside back then. One of the things that's cool to keep in mind is like the Bitcoin dominance. Normally, Bitcoin dominance increases in bear markets and decreases in bull markets. And so what that translates to is that altcoins have like more beta when we're rallying and have more beta when we're falling. So theoretically, there's like extra vol. There's like an extra move from the altcoin space, no matter what direction we go. And so to me, that's another reason that, relatively speaking, the ETH vol is cheap. One of the things, just kind of jumping here though, one of the things I find really interesting, so now you can stake ETH and earn a yield. And if you have like a big position of ETH that you're staking and you're earning a passive yield, and then you could sell covered calls against it. Obviously, there's collateral management issues, but let's set those aside for a second. Essentially, ETH becomes a yield machine because you're getting yield on your underlying asset, you're getting a dividend, and then you're selling a covered call. And so theoretically, you're kind of making double income. Now, one of the things that's really interesting is the forward. So people were talking about this in the Paradigm GVOL or Paradigm Amberdata vol pit. Why is the ETH forward trading at similar levels as the Bitcoin forward when ETH is now a yielding asset? So traditionally in traditional markets, if something has a yield, the forward trades cheaper because you're going to synthetically earn that yield from a cheaper forward. We're not seeing this in Bitcoin right now, and I think this is part of the interesting thing. So this means, just real quick, I don't want to jump ahead too fast, but if we look at the September merge of last year, the forward was pricing in sort of that passive yield, and so the forward was trading at a discount of, call it 2%, while the Bitcoin forward was trading at a 1% premium, so there's a 3% spread. And that kind of sustained until we had the FTX scenario, then everything kind of converged. And then that relationship just like disappeared. Like people just stopped pricing that in. And now we see Bitcoin forwards and ETH forwards just really trading in lockstep. I think that's an opportunity. To me, the ETH forward's a little overpriced. It's not pricing in that yield. And so that means the calls are too expensive. The calls are overpriced because the forward on that call is overpriced. Yep. And the puts are underpriced. So it's really interesting to be someone who either holds ETH and sells covered calls against it, or the fully collateralized way to do it, which to me is the simple way, you don't have to deal with collateral management, is that you have a chunk of ETH that you're staking, you sell 2% of that, send it to Deribit, and buy a ton of puts to cover that position. Now there's no collateral management issues at all. And so you're earning a passive yield, you're buying undervalued puts, undervalued in terms of vol, which that's just kind of more of a bias of mine. Yeah. But B, undervalued because the forward is overvalued, which is kind of more of a technical, statistical arb, so to speak. And so to me, that becomes like a really interesting position. And that's kind of how I'm thinking about it.
That is super, super interesting. I had not thought about that in the context of the ETH forward. And, I think, so in terms of staking yields, apologies for not knowing this, for ETH, what are they, around like 5 or 6% right now?
A bit lower than that, yeah, I think.
Yeah, 4% according to ultrasound money.
Okay, right. And then if you do, let's say in this case, you did the covered call on top of that, what sort of yields, if you've looked, like what are we looking at here, right? If I'm like selling kind of like 1 month, say 1 month, like 15, 20 delta calls, against this position, like roughly in terms of yield, what do you think I'm looking at?
Yeah, actually, we have this chart. Let me just share it real quick. Let's get out of this. So we do have this here. So covered call. Let's say I'm doing the covered call for that September. Let's say we're selling that. This is going to be the annualized. Oops. Here's the absolute yield for the covered call. So if I'm selling like the 2,500 for September, it's like another 3%. So call that, 3 plus 4, so 7. if I'm looking at that in annualized terms, that's like 15%, 12%, 8 plus 4. That's kind of interesting in annualized terms.
That's super interesting.
Yep. Obviously, if you're selling at 2,200, which is what we're seeing, that flow, that's a 14% plus 4, so 18. Plus the upside.
Do you think it's reasonable to say then that, given that opportunity now, and now your sort of staked ETH is liquid, so you can truly kind of write a covered call on it. In terms of if you did get called on it, you can actually take your staked ETH out. Do you think it's reasonable to suggest that that ability to do that and earn that extra yield is a big factor in what's compressing that ETH Bitcoin yield to the levels that we've seen, and even driving it under in parts? And there's in terms of the vols.
So here's how I think about it. So let me just go to this chart real quick. So this is going to be a long-winded answer to your question, but when we looked at sort of the outstanding open interest and option activity in ETH, sort of the peak amount of open interest on Deribit was during that September merge. And a big narrative driver at the time was like, okay, now that ETH is a yielding asset, for sort of traditional players, it kind of looks more interesting to buy and hold and earn a dividend than to speculate in crypto for capital gains. That was a little bit of the narrative. I mean, you guys probably have a better idea than me on that, but typically institutional investors buy assets and sell covered calls. Like, that's the traditional flow. You see that in SPX. They buy puts, they sell calls. And so if that narrative of like now ETH is a yielding asset, so it should attract institutional capital, then theoretically, institutional players will do institutional strategies, and selling the covered call is like the most basic institutional strategy that we know to be persistent in the space. So assuming that narrative is true, I do think that is a driver. Yeah.
I think it aligns well with what we're seeing in terms of clients that are trying to come in onto Paradigm. There's a lot of customers that kind of in our pipeline that are kind of just looking at ETH vol selling strategies. And I think this kind of just hits the nail right on the head, kind of what we're discussing here, of why we're seeing that. It's like this opportunity to be able to, stake my ETH and be able to take it out if I get assigned on these calls.
I think as well, something that's made me sort of relatively more bullish ETH for the last year or so, was not just you had obviously the move to proof of stake and the opportunity to earn yield and what have you, and the idea, the supply impact that will have, alongside the fact that we're also sort of deflationary. The other thing, and when we talk about institutional adoption, is that it's always in the back of my mind, is when you look at some of the sort of more institutional custody solutions out there, they all started with Bitcoin, right? And then like ETH's been the kind of second coin that they've started to custody and offer a fuller service around. And again, I wonder now those solutions are now and there's various custodians that have now included ETH. So now it's just more viable for institutions to buy and hold ETH. Before it was all just Bitcoin. Now it's Bitcoin and ETH, and obviously over time we'll sort of move out into some of the other alts. But yeah, I just wonder if now it's more viable from a custody point of view to start looking at buying ETH, and then you're going to want to sort of overwrite some calls on that, as well as the whole staking thing and liquidity that you're getting, and then this yield potential. Kind of when you put all those things together, what we're seeing, I guess, makes a lot of sense.
Yeah,
I think that's totally right. Yeah, go on, Greg.
I was going to echo that. Yeah, the infrastructure for investing in ETH is sort of, the pipelines are built. Yeah.
Right. And you don't as well now, kind of, last year or 18 months ago, had this sort of opportunity cost of like the yield farming, where people are like, oh, I can make 20%, on, my Terra Luna exposure and these sort of things. Like, I think people now are looking for like actual real sources of yield, not just yield that is being defined and driven by inflationary tokenomics, right? Selling vol has been a form of yield that has existed since the late 1970s, right? It is a proven form of yield. And I think, institutional investors now, and, even retail investors are like, okay, let me shift. If I'm looking for yield, let me shift my allocation to vol rather than, looking for these sort of, Ponzi-esque yield farming opportunities. So I think that's part of it as well.
Yeah, totally. So I think here's like where the true opportunity lies. So let's say we all agree that maybe the forward's overpriced, and so the calls are overpriced, the puts are underpriced. Then it's like, okay, what's our opinion on vol itself? So when we look at the relationship between ETH vol, realized vol, and Bitcoin realized vol, theoretically, an asset with a smaller market cap should have more vol to it because it takes just less money to move it around. So that's one component. The second component is we're seeing growth in sort of the staking on the Beacon chain. While ETH that's staked is non-tradable ETH, essentially. It's out of the tradable float. So we have about 21 million ETH on the Beacon chain. We have about 120 million total supply. So, 16% of the ETH is outside of the trading float. So that means that the market cap, which is, call Bitcoin 500 million, ETH 200 million. Well, now the tradable market cap is a little bit lower, so call it 170. And so theoretically, it takes more money to move Bitcoin than it does to move ETH. So now, this is like, to me, the opportunity is here where like maybe there's institutional investors that are selling covered calls, and that affects the implied space. But the opportunity is that, well, if we have like a bull cycle or a major market crash, the realized space should theoretically go back to traditional relationships. And this is where, if I'm going to trade the underpriced puts or overpriced calls, like, to me, it's buying the underpriced puts, getting long ETH, and then staking that ETH. That's the more interesting trade here. And I think that's where there's opportunity, or sort of taking the other side of the flow. And I don't know, if I'm an institutional investor and I'm selling covered calls, like, I'm not a vol trader. I'm trading vol, but I'm not a vol trader. There's a difference there. I don't know what you guys think about that.
Yeah, I'm just trying to get my head around and think, if you're in that scenario, I kind of get the idea that the calls are overpriced, the puts are underpriced. So yeah, you sort of buy the ETH, stake it, buy the puts. Just that how that performs in a bull market, when the convexity and everything's going higher, and are you just sat there on this, wasting sort of premium, if you like. I don't know if I'm thinking about that in the wrong way, but
yeah, I just think of it as a synthetic straddle. So like, it's still a straddle, but I'm long half of it. I have the synthetic straddle, and then
got you. Yeah. No, that makes
that
makes sense.
I would buy extra puts is basically what I would do. So if I'm buying half the money puts, buy twice as many as how much ETH you're staking.
Well, I'll tell you what, market makers on Paradigm are stuffed with long downside puts. So if you want to come buy them, you'll be able to get it. That's the thing. I mean, it's what you've been noticing. Like, honestly, like, you have these sell-offs. You have market makers that are just getting longer Vega and longer Gamma as they're approaching these downside strikes, and they're just hammering this stuff, selling it out on Paradigm. And if you find somebody that's looking to buy the puts, then absolutely fantastic. But like, you're not really seeing that sort of natural demand for it. So it kind of just it's your argument. It's just something that you do believe in. Well, you're going to get a good price as well, just due to the dealer positioning, looking to shed some of this stuff. And I think that positioning is, one of the kind of drivers, if you will, for kind of this spot down, vol down. It kind of just feels like dealers are kind of, long this sort of like buy, put, sell, call sort of risk reversal So as spot goes lower, they're getting longer vega, and they need to shed some of that because the downside for fixed strike balls just haven't really performed.
Joe, I've got to say, and it's perhaps more spidey sense than based on anything more sort of fundamental than that, but it does. I wrote my Macro Pulse newsletter on the weekend. I called it the calm before the vol storm. And it just feels that, you see it in all markets, in traditional markets, when you get this level of apathy, despite there being so many risks out there right now. Obviously, we've got like the debt ceiling risk. We've still got, uncertainties around what the Fed are doing in terms of hiking or pausing. There's a lot going on. SEC risks, all this stuff. And yet we've got this malaise and this apathy in markets, which are kind of lacking a narrative. But it kind of just feels like something's gonna sort of break and blow up. I just feel we might be at that point of apathy where it's go time.
Yeah, it kind of reminds me pretty similar to kind of what was happening in December when, the implieds and realized. I think that like the BTC implieds were like in the low 30s, like around like right after like Christmas time or something like this. And, of course you always have like, the pundits out there, haters be like, oh yeah, but realized is 17. It could go lower. Realized is 17. But like there's a point where it just gets so low where it's just like, look, I'm willing to kind of like bleed theta here because if it does go, the thing is just going to completely explode.
Yeah. What I will say, Greg, to like your trade idea, as you know, I've been pretty bullish this year on crypto for these sort of macro dynamics. I tweeted out earlier, like what we're seeing in markets today and this week. Obviously, the debt ceiling debacle is kind of muddying the waters quite a bit, and we've kind of got this relief rally in stocks, which is on the idea that it looks like we come into maybe some deal, and I completely think obviously we will see that debt ceiling lifted. So stocks are up, but also sort of bonds are selling off, yields are going higher. The dollar's getting stronger. You've got a concerning dynamic for me in China with dollar China trading above $7. And signs of capital outflow, which in some ways actually that the capital outflow story is good for Bitcoin, but typically as well, the PBOC will look to sort of squash any flows into it that are leaving. So you've got like dollar CNH looking a little bit unstable and sort of feeding broader dollar strength. You've got yields going higher in anticipation of the issuance that's going to come from the debt ceiling lift. And then when the debt ceiling does get lifted and from that issuance, you're going to have a huge liquidity drain. And I'm talking like short term, but I think short term, I think we're going to be under quite a bit of pressure. So you might be thankful if you're holding some of those puts, and actually you might start to see that vol pick up to the downside.
Yeah, totally. And one of the things, so we know how dealers are positioned. Joe, you kind of mentioned, if you want to buy puts, you can buy some inventory from dealers. David, you made a good argument for potentially we could see a lot of downside. And so there's this kind of thinking when you're new to the market, you go, well, isn't the market efficient? Like, isn't all these things priced in? And the way that I think about it is that the market's, I said this earlier, but the market's cyclical. So it's like value investors, win in certain types of markets. There's a market when 2008 is a great time where like the value investor who's done all this fundamental analysis and knows this company's going to survive, blah blah. That's their moment to shine. And so this is kind of how I think about it as well. Like right now we have some players out there who are selling covered calls and creating a supply of vol and stuff like that. And there's a little bit of a malaise in terms of the realized vol, and there's this cycle right now where we're seeing ETH vol super low, realized vol for both Bitcoin and ETH very low. And so you can make the argument that this is just cyclical, but it brings you back to this idea in the term structure. If you still think that, you don't necessarily want to buy vol or you're unsure or something like that, like to me, given where we are, the term structure is still kind of too flat. Or, I mean, it's a little bit contangled, but it's not contangled enough. And so again, this is another way that you could hedge that out. So let's say you want to be long the synthetic straddle by buying ETH puts, and then buying ETH and staking it. You can finance some of those long-term puts by selling some short-term puts against it as well. So let's say you own 50 actual ETH, you own 100 ETH puts. You can sell another 50 at the shorter end of the curve to sort of finance it, because the term structure, given where realized is still kind of flat, in my opinion. We've seen it much lower at higher realized vol regimes. And so that's another sort of distortion. And essentially, when you're trading vol, you're just looking for things that are relatively cheap and relatively expensive. And so this is kind of where I'm seeing it. And if we do get that downside move, just from the macro space, theoretically, ETH should have more downside to it. And if we get the traditional bull market, ETH should have more upside to it. So kind of how I'm seeing everything.
Yeah, super interesting. And you think that term structure steepness is going to be mostly driven by the front end just coming lower, do you think?
Yeah, typically that's typically how it gets priced in, because like things are not moving right now. So like right now options will be cheap. Yeah.
Yep. No, that makes total sense. I'd agree with that. So one thing that I wanted to segue into, a lot of times you don't really get a lot of like crypto options, like current event news. It doesn't really like exist too much, right? And there was some pretty big news that came out earlier this week, and that news was, so Galaxy Digital, obviously big player in the crypto derivatives world, executed against CoinFund likely the world's first OTC bilateral option contract on chain, to reduce credit risk and improve transparency. And so on-chain trading, it involves the use of smart contracts to manage the collateral, which ensures the payment is going to happen even if the counterparty defaults. So as we all know, margining as of now is done off-chain. That's certainly the case in TradFi assets, and it's even the case in the crypto OTC world, right? So crypto OTC options look a lot like an OTC option in equities, except your underlying is crypto, right? So this ability now to be able to execute margin and settle this trade in this trustless environment, it's kind of like it sounds like to me a lot like just like a multi-sig sort of wallet, right? Two counterparties set up a shared smart contract wallet they jointly own, and no party has unilateral control of this thing, and both parties need to approve a transfer of collateral, a transfer of settlement before it can happen. And I think it's just super, super topical right now, and I think the move makes a lot of sense, especially due to this collapse in counterparty trust post FTX. I think the reality is we kind of still live in a world where it's difficult to trust the solvency of a counterparty. And we used like this example earlier in the episode where it's like, oh, if I want to buy a 10 delta ETH put, well, like, how do I know that the person I'm going to buy it from is going to be able to make due on that obligation, right? Odds are, if that 10 delta put actually goes into the money, I wouldn't really be too comfortable. Given what happened last year, they could have things on their balance sheet that are extremely, extremely correlated to that ETH put going into the money and reduce their ability to fulfill that obligation on the put. So I think it's just a really interesting idea, like actually using crypto for what it's designed for, but in the practice of being able to settle OTC trades. I'm curious to hear what you guys think about it.
Yeah, my point of view, I think particularly for those of us who have come from like TradFi and into crypto for all the exciting reasons about seeing, the kind of future of finance, evolving through the sort of blockchain space, I kind of think is where we want to be, right? Ultimately, we want to be like decentralized finance. Now, I say that as someone who, works in a company that, to begin with, we kind of built on the centralized rails. and facilitating access to that. But ultimately, I think, we all want to see it go sort of decentralized and everything go on chain, and to have on-chain settlement and to really kind of fulfill the core kind of ethos of why we're here. I think about crypto. I mean, I was quick to say after FTX, to people like, look, this isn't crypto. This is the failure of a centralized actor in the space, which actually goes to reinforce the value proposition for Bitcoin and the idea of having decentralized trustless forms of value exchange. And it's kind of, that's great. But actually, a lot of the trading business around it is still very centralized, relying on centralized actors. And you're like, that's step one. Step two, eventually we start to sort out some of the KYC and AML issues that come hand in hand with how do we take things on chain. But to see this happen is pretty awesome, I think. And again, it's like, it might be one of those things that we look back on and go, wow, that was quite a pivotal moment. And we spoke about it on the big picture, and maybe didn't give it enough hype, but actually that's a pretty fucking big deal. And I think it is.
Right. I agree with that.
Joe, was it fully collateralized?
So the collateral is determined by the AVO. So the trade was executed on a contract on AVO, which is
cool.
The option dex of Ribbon Finance. I actually haven't looked at the collateral terms within that smart contract, but it's whatever those terms are.
AVO is awesome. I actually just traded some ETH options for the first time on it yesterday.
No kidding.
It's cool. I really like it. It's really interesting. The other one I'm really kind of big on is Lyra. I think one of the things with on-chain, I definitely like decentralized, and I think there's a lot of things that are instantly solved by decentralization. So like, for example, fraud or like accountability of where funds are going, which is a great example that would fix FTX, because obviously they're taking customer deposits and going and trading those on a levered basis.
Yep.
Good job, Sam. So that fixes that. But the issue of like trading options on a partially collateralized basis, I don't know that blockchain fixes that. It fixes the transparency component, but the blow up risk, like by definition, kind of always exists there. Just like any insurance company, if you're one insurance company selling earthquake insurance in California and the whole state moves around and houses break, I don't think that problem can ever be fully fixed. And if it is fully fixed and it's fully collateralized and it's inefficient, so I don't know that, I think we'll always navigate that issue.
Right. Yeah, absolutely. I'm not saying that like this is kind of like the end all be all solution. We're here, but I think it's certainly a step in the right direction where it's like, look, through this smart contract, I have this ability to potentially to automate collateral transfer, monitor the market in real time with the inputs that are driving that in this open source nature, right? And the liquidation is automated, like the amount of cases, like even when so March 2020, when I was working at JP Morgan, like when the world was blowing up and we had all these customers that were doing all these short vol convexity trades, like being able to like get some money, it was like to get something was like impossible, and like insane like legal headaches that were going on. Well, as opposed to, well, if this stuff is kind of like there in the smart contract and you get liquidated, well, at least you get something, right? So it kind of solves for that. And then I also think it's interesting, like it's asset class agnostic, right? You have the ability to take these, smart contract rails and bring it to any other asset class, right? You have this ability to, maximize speed of settlement. You don't need, and you have this ability to lower costs, right? Like when I was on the desk, like 20 to 30% of the people that were sitting on the trading floor were basically handling collateral management and settlements. 20 to 30%, right? Yeah. That is a lot of salaries that you need to pay to basically just have money going back and forth between counterparties on bilateral OTC transactions. And it always got fucked up too, right? Like there would always be like a case where like, oh, like I don't see you guys posted margin, right? Like, oh, hey, we margin called you like 3 times. Like, where's the margin, right? Like there's just so much like headaches that were caused by this, where like now we're kind of working towards this solution to kind of be able to solve for all these frictions that it also exists in TradFi.
Yeah, for sure. Like operation costs, legal costs, like if it's all automated, that's huge for sure. That's huge savings.
Yeah, it still amazes me. Like obviously having spent 18 years working on sort of trading desks in banks, like you would literally get someone from back office would call you and say, look, we're owed some margin on this trade. We're not hearing anything back. It's been 5 days now. Can you kind of reach out to your contacts and just say what's going on? Like, right? Yeah, I'm hearing about this. It's 5 days, right? But typically, again, it's like all these things, right? Most of the time, it's okay, and it's all okay until it's not. So you kind of okay, yeah, and we know them. They're good credit, it's fine. And there is usually a reason, some kind of admin error, or oh sorry, yeah, we missed that, and there you go, and it's all done. It's not an issue.
Well, but it's a big time waster, right?
It's a big time waster, yeah.
And then you need to. I mean, sorry if I'm being blunt, but like you're paying people to like do these things, right? As opposed to if you're able to automate all these kind of functions away, via like just multi-sig wallets and bilateral OTC trades. Well, like I think that's a huge step.
Yeah. Mm-hmm. Yeah. I mean, it reminds me of some of the older guys I used to work with, who go back to when they were sort of manually writing tickets and all this stuff, all these cool stories, and they look back and go, it just seems crazy. It seems crazy now, to think that we were doing that, in a world where computers and what have you come into it. We'll all be looking at that in the next 10 years, going, it was mad. Do you remember that the US had to wait 2 days to settle the trade, 3 days to settle a trade? You go, that was crazy, right? Why would it take that long? Right. And we're moving into that world, and it's exciting. It's going to unlock so much like economic value in the world. Mm-hmm. It's going to create a lot of issues in terms of thinking about the number of jobs that will disappear because of it. But equally, I think people threat on that. It probably ramps up productivity, and we kind of just evolve into different. Everyone's going to be coding and programming or have you to kind of take advantage of that. But man, it's super exciting, and we're at the forefront of it, right? It's amazing to see it. So yeah, kind of looping back to the original kind of question, I think it's pretty exciting what we're witnessing here.
Yeah, definitely. Go on, Greg. Sorry, cut you off.
Real quick, you were mentioning about like unlocking economic value. So like a great example is back in the day when people were like running tickets and trading on the floors, and before the internet bubble or the internet innovation and online brokerages, spreads between stocks were like 25 cents minimum tick size. Now we're sub penny, and like that translates directly into making it cheaper for everyone to transact in the market. Not to mention like the brokerage costs to transact in the market have come down a lot. And what does that translate to? Well, that translates to a more efficient market because more people can participate in it and basically express their opinions. And I'm a strong believer that financial markets are the biggest information processing engine that we have. This is the biggest society information processing engine. And if you look at sort of economics as a social science, and if you look at social sciences, well, economics is the most legit social science out of all the social sciences because it has measured, periodic, very robust data sets that people can essentially study. And even given all that data, you have PhDs with $1 billion funds under management, and you could take $2 billion funds with teams of PhDs, and they're looking at the same data set and having a 180-degree opinion on the implications. And so to me, like, all that stuff leads to more efficiency. And so that efficiency leads to collective, price decreases and capital allocation, stuff like that. So it's useful.
Yeah, no, it makes sense. And, you've been just speaking to some dealers about this news. They're like, we went from a world where it was like, if you were doing like an interdealer, like bilateral OTC trade, like off of Deribit, like back in 2022, like there wasn't really much margin at all. Like I would have conversations with these guys. I'm like, how does like your IA and variation margin work? And they're like, yeah, we weren't really doing it. Kind of just like trusted people were going to be able to make up on their obligations. And now the pendulum has completely gone the other way, where everything is just like fully collateralized OTC. And speaking to some dealers, they think like this on-chain sort of settlement or bilateral OTC trades is going to be very, very good thing for the interdealer OTC market as well. So that's just some customer feedback from Paradigm. But we're coming up on the 51-minute mark. Guys, have anything else? Any closing thoughts, or good to end it from here?
I guess just from me, just on the macro, and again, I'll repeat, as someone who's been pretty and remain like bullish over the course of the year and the medium term on crypto, I just think we're in for a difficult period. I think we all need to be conscious of the fact that what's going on in China and dollar China sort of breaking above 7. I think that's potentially problematic. I think this debt ceiling lift, we've got this kind of euphoric sort of feeling certainly in other risk markets at the moment, as we kind of, it looks like we're approaching that agreement to lift the debt ceiling. It's going to be a huge liquidity drain on markets, which I think is going to create some problems in the short term, I think, for crypto. So a little bit of caution here, and tempted to kind of fade some of this sort of euphoria and think we'll test a little bit lower.
Yeah, David, I always thought you were a perma bull. The fact that you're getting bearish here.
Yeah, do you know what? I've never in my whole career I've never understood the perma anything tags. It's like, how can you have a framework and look at things objectively and only ever land on one side of the coin, like I've never got that. I mean, yeah, anyone who since we've started doing this, I've been super balled up on crypto because of that change in dynamic. I'll be quick to flip when when the macro sort of dynamics change, and even if there's some like idiosyncratic reasons to be bearish crypto. Say not super bearish right now, I think, and there's other offsetting things to this liquidity drain. I'm also, by the way, I'm a pretty shit day trader, so I don't mess around with things sort of too much, because I'm never going to be one to call the top and buy the lows, but typically I like to think quite good in terms of positioning for these kind of medium to longer term sort of macro thematics. And so from that point of view, I'd still kind of stay long, and I think we end the year higher in Bitcoin and ETH. I just think short term, if I was going to have caution, I think it's the first point this year that I've felt a little bit more cautious on this market, just because I think liquidity has been such a tailwind throughout the first few months of the year, and we're about to see some of that get zapped out as we raise that debt ceiling. So just a little bit more caution, which, given where vols are, creates probably some really decent opportunities to start trying to pick up some cheap vol.
Yeah, definitely. I think that cheap vol narrative for ETH will make sense to me, either on the downside or the upside. So,
well, awesome, guys. That was a fantastic episode. We really covered a lot there. So, Greg, love having you on. Thanks again for joining. We'll certainly get you back on within the next couple months. So thank you, everyone, and we'll see you next time.
Yeah, cheers, guys. Thanks, everyone.